April 8th to 30th. Following the repo rate hike of 40 basis points on May 4th, the WACR, that is the weighted average call money rate, has further increased, averaging 4.07% during May 5th to 31st. I'm taking May 5th because there was a rate hike on May 4th, as you would recall. In line with the emphasis on gradual withdrawal of accommodation articulated in the MPC resolutions of April and May, systemic liquidity has moderated in the recent period. Surplus liquidity as reflected in average daily absorption under the liquidity adjustment facility, that is the absorption under SDF and the variable rate reverse repo auctions of 14 days and 28 days at 5.5 lakh crore. In other words, what I'm saying is that the surplus liquidity as reflected in the daily absorption under the LAF at 5.5 lakh crore during May 4th to 31st was lower than 7.4 lakh crore during April 8th to May 3rd. Nevertheless, the overhang of excess liquidity has resulted in overnight money market rates on an average trading below the policy repo rate. At the longer end of the money market term structure, interest rate on 91-day treasury bills, commercial papers and certificates of deposits have firmed up post the rate hike in May. Yields on AAA rated 5-year corporate bonds have also increased. The rate hike also led to an upward adjustment in the benchmark lending rates by the banks. The term deposit rates of banks have also increased, and this will augment stable funding resources amidst increasing credit demand. Going ahead, while normalizing the pandemic-related extraordinary liquidity accommodation over a multi-year time frame, the Reserve Bank will ensure availability of adequate liquidity to meet the productive requirements of the economy. The Reserve Bank will also remain focused on orderly completion of the government's market borrowing program. I have not listed out in my statement what steps we will take to ensure orderly implementation of the government's borrowing program. That is because we are monitoring the GSEC market very closely, and necessary steps would be taken by the RBI as and when required, as per the evolving scenario. A direct fallout of the geopolitical tensions and the rapid pace of monetary policy normalization by advanced economies is the exodus of portfolio capital flows from most EMEs. Several EME currencies have thus faced depreciation pressures. Safe haven demand for US dollar has increased amidst all this. The Indian rupee has moved in an orderly fashion and has depreciated by 2.5% against the US dollar during the current financial year so far, that is till yesterday. Now this has fared much better than many of the EME peers. In other words, the performance, the Indian rupee has actually performed much better than the other EMEs and the many of the EME peers. Amidst all this, the Indian banking system remains strong and its health has improved in recent years as reflected in key indicators: capital adequacy, asset quality, provisioning coverage and profitability. Bank credit offtake has gradually improved in recent months, supported by both resilience of the banking system and progressive normalization of economic activity. The strength of the banking sector and deleveraged corporate balance sheets will help us in sustaining economic recovery. I would now like to touch upon the external sector. India's exports have performed exceptionally well despite weakening recovery across major trading partners. The impact of rising crude oil prices on petroleum, oil and lubricants, that is the POL import bill, has been partly offset by export of petroleum products, which also benefited from better price realizations in the recent months. Optimism on exports of both goods and services and remittances should help contain the current account deficit at sustainable level, which can be financed by normal capital flows. As on 3rd June this year, that is as on 3rd June, India's foreign exchange reserves were of the order of $601.1 billion US dollars, which are further supplemented by a healthy level of net forward assets of the RBI. Now, before I proceed to announcing certain additional measures, let me just say that the situation overall is challenging, but as we have dealt with the difficult situation that we were confronted with during the pandemic, we are committed and determined and resolute in dealing with the current challenge to the Indian economy, most of which are emanating from external factors. So that is a point which I would like to make emphatically. I shall now announce certain additional measures, the details of which are set out in the Statement of Developmental and Regulatory Policies, which form Part B of the MPC statement, and this will be uploaded in the RBI website soon after my statement is over. And the additional measures are important, and they are as follows. The first set of announcements relate to regulatory measures in respect of cooperative banks. Considering the importance of cooperative banks in promoting inclusive growth, 3 measures are being announced for the cooperative banking sector. 1, the limits for individual housing loans being extended by urban cooperative banks and rural cooperative banks, which are basically state cooperative banks and district central cooperative banks, which were last fixed in 2011 and 2009 respectively, are being revised upwards by over 100%, taking into account the increase in house prices. This will facilitate better flow of credit to the housing sector. The second point relating to UCBs, the cooperative banking sector, the second announcement is that in line with the dispensation available to scheduled commercial banks and urban cooperative banks, it is now proposed to permit rural cooperative banks, and they consist of, as I mentioned, state cooperative banks and district central cooperative banks, to extend finance. So we are permitting the rural cooperative banks to extend finance to commercial real estate, that is residential housing. And this will be basically loans for residential housing projects within the existing aggregate housing finance limit of 5% of their total assets. This measure will further augment credit flows from the cooperative banks to the housing sector. The third measure in respect of cooperative banks is that we have decided to permit urban cooperative banks to extend doorstep banking services to their customers. This will enable the urban